It's 9 a.m. here in Hong Kong, in Beijing, and in Shanghai. Welcome to Bloomberg Markets, China Open. I'm David Ingles. Let's get to your top stories today. Japanese firefighters are still battling blazes after a powerful earthquake killed at least 8 people. Authorities warning of further aftershocks, with some tsunami alerts still in force. President Xi Jinping pledging to strengthen China's economic momentum after a rare admission that it was a tough 2023. And on that note, we'll be getting the Taishin December PMI numbers this hour. That's after the official factory reading a few days back contracted the most in 6 months' time. Welcome to the show, first one of the year. Hope you're all rested and ready for perhaps what hopefully will be a better year for equities this part of the world, particularly in China. We'll talk about the economy in just a moment. Right now, Happy New Year. We turn a page, of course. Do we pretend things are very different? Okay, we'll get to that in a moment here. 0.2% to the upside. A50 futures in Singapore just coming online, so it's looking like we will get maybe some modest gains. Just keep in mind, we're coming off quite a strong 3-day rally in the A-share market, so we might build on that momentum going into the open today. Japan and New Zealand are shut. We're down about 1% on Nikkei futures. In Singapore, as you can see, we're down about 1% on that as well. Flip the boards, please, if we can. A couple of markets coming online. You have Singapore, where we had GDP numbers coming out about an hour back. Bottom of your screens, in case you missed that. Malaysia, Taiwan coming out as well. Kospi index down about 0.4%. I think yesterday we had the export numbers coming through, and we'll tie that together with the new export orders, which I'll get to in just a couple of minutes here, out of the PMI numbers, which actually didn't show encouraging signs moving forward. FX markets, will this be a year where yield differentials and rate differentials continue to favor outflows from dollar assets? 141.18 right now, so we're slightly weaker compared to about 2 hours back on the yen. 140 and change earlier back. Aussie dollar trading at flat, so nothing much to tell you about as far as currency markets right now are concerned. Bond markets, interesting enough, so no cash treasuries. You have treasury futures trading down, so yields would be pushing higher if they were trading up right now. We're following what's been happening, particularly in the last, I'd say, week and a half, maybe even 2 weeks, on CGBs, where the 1-year yield, in fact, is down, I think, 8-9 straight sessions, and the 10-year actually at 4-month lows, or 4.5-month lows on the Chinese 10-year yield. And commodity markets, you have oil in China, you have iron ore, which is trading at about the highest since March or April of 2022. Bottom of your screens coming out, and shortly will be the iron ore price. There we go, in Dalian, up 0.25%. Now, that's the market story for now. It's relatively quiet. We'll see what happens with this next few hours or so. Let's turn our attention to our top story this hour, the big quake in Japan, where authorities are warning that there may be further aftershocks after the powerful earthquake on Monday. 7.6 magnitude quake, northwest coast, killed at least 13 people and triggered a widespread tsunami warning. Joining us now out of Tokyo is Isabel Reynolds. She's with us with the latest. Isabel, this is a developing story, obviously. Just get us up to speed here.
Right, as you say, 13 people have already been reported dead in this area. Fortunately, the quake hit on the northwest coast of Japan, which is relatively little populated compared to the other side of Japan, which is where Tokyo and the big cities are gathered. But this is a kind of a remote peninsula where the worst damage has happened. In the city of Wajima, which is at the north of the peninsula, there's been an enormous fire, which firefighters are still trying to tackle. It seems to have destroyed about 100 buildings in what was a very popular tourist area, a kind of fishing market that tourists love to visit. Other damage has been caused to roads. Roads have buckled, buildings have fallen down, train services have been halted. The local airport on the peninsula has been closed due to cracks in the runway. So the rescue operation is going to be very much hampered by the damage to that infrastructure, I think.
Isabel, just coming through right now out of NHK, so earlier on, there were still some tsunami warnings. As of right now, NHK reporting that all tsunami warnings have now been lifted. It takes us into, to your point, rescue efforts as well. What about local infrastructure? What have the effects been so far?
Right. Well, we've seen a lot of buildings fallen down. As I say, it's a bit hard to get a very full picture of what's going on, but there are reports coming of people still stuck under those broken buildings. Roads have been damaged, so it's hard for rescue operations to get through at this point. And also, one of the most important issues here is the nuclear power plants. There are two of them in the region. The Shika plant, we saw some very mild damage, which doesn't seem to have affected operations or caused any leak of radioactivity outside the site. But also in that area, we have the Kashiwazaki Kaniwa plant. That is the largest one in Japan, and restarting it has been one of the key parts of Japan's power plan for the years going forward and of its climate change plan. So having an earthquake in such a proximate area to that could play into public opinion over whether this is a good idea to restart the plant.
Yeah, that takes us into, I guess, the broader conversation. You know, when we first heard the news, when at least for me, immediately, I mean, it's 12 years, 10 months to the big one back in March of 2011, and immediately my mind just took me to nuclear and what that means. What does this actually mean? If you could talk a little bit more about that, nuclear plants in the area and whether or not that does affect supply of electricity.
Yes, well, these two big plants were certainly offline at that point. We have seen thermal plants go offline, so that's caused power cuts to about 40,000 households in the area. But yes, as you say, this warning of a tsunami triggered those fears that most people have if they remember that huge disaster in 2011. However, that large tsunami never materialized. The largest one that was recorded was 1.2 meters, which is about 4 feet. So it was nothing like on the scale of what we saw back then. But as I say, even this very mild damage, like a transformer was damaged at one of the plants. There was some kind of slopping of water out of the fuel cooling pool. And those kind of issues will play into the psychology, I think, of whether people in that region feel favorable towards restarting those plants. And that will raise questions over how Japan is going to supply its country with energy over the coming years.
Isabel Reynolds are in Tokyo for us, just getting us up to speed on the quake and what's taking place right now in Japan, that part of the country. Thank you so much. Right. From Japan, let's turn our attention to China. So key data points out. On Sunday, we had the PMI numbers out, missing virtually every single estimate with the exception of one. So 49 was the headline. Two things stood out, at least to me here. So new export orders, actually, this is not a major component, but as you can see, falling to 45.8, which takes us basically back to the lowest level for the year in 2023, perhaps does not bode well in terms of external demand. The other thing that stood out, though, at least in the positives, business expectations. So are things going to get better, yes or no? Above 50, below 50, actually rose to the highest level going back to about Feb of last year. Now, just flip the page, please. Let's have a look at all the data coming through. Property sector, that's going to be key and front and center really to most conversations in China this year and to what extent this recovers. So top 100 developers, you measure sales on aggregate 35% down in December year on year, full year down 16%, missing estimates as well. So that takes us into the data this hour. Caixin numbers coming out in about 37 minutes from now. For more on what to expect, let's bring in Jill Deeses, our China economy editor, to take us through, of course, your takeaways so far.
Yes, David. Well, ultimately, we're waiting, as you said, for that Caixin manufacturing index later this hour. What this will maybe show us is maybe a bit different from what that official gauge showed us. Remember, that Caixin index measures a different number of companies looking at different geographical locations. Many of those are smaller and more export-oriented. So I believe the median expectation among economists surveyed by Bloomberg is actually for that index to rise a bit, maybe not as high as in November, but ultimately still in expansion territory. We'll see if that actually carries through. But I do think that, despite the fact that we had some green shoots in that official data over the weekend, there's still that headline gauge still fell into contraction deepest in 6 months, indicating that, look, it is a bit of a slower season. December, also, we've got some weather-related issues that kind of play into that. It's a bit colder, so maybe activity isn't as strong. But still, I think, indicates that there are some concerns about the economic recovery headed into 2024. I think raising the expectation that maybe the central bank has to do more to sort of support the economy. Maybe we're seeing another rate cut within the next couple of months. But yeah, so we'll ultimately see whether that private gauge that we're getting in about 30 minutes or so indicates that at least the smaller businesses are doing well. But that remains to be seen ahead.
Yeah, we'll see. And I guess to the point that you're making, our colleagues at Bloomberg Economics do think, of course, rates will be lowered even further in China. Let's throw this forward. President Xi Jinping, New Year's address, talked about some of the challenges to come. Before I ask your take on that, let's play it out, guys, if we can, for our viewers to see what he had to say.
On the road ahead, wind and rain are normal. Some enterprises are facing operational pressure, and some people are encountering difficulties in employment and life. And natural disasters such as floods, typhoons, and earthquakes have occurred in some places, all of which I'm deeply concerned. We are not afraid of hardships. We will watch out for each other, face up to the challenges, and overcome the difficulties.
Yeah, Jill, just rare, I guess in some ways, rare admission that 2023 was challenging for a lot of companies and a lot of people as well. He underscored they're resolute in pushing economic momentum.
Yes, yes, it was a bit of a rare admission there in kind of talking about some of those economic challenges in 2023, David. I also thought that, he made a reference to the need to sort of bolster youth employment, careers for young people. As you might recall, last summer, the Beijing stopped publishing youth unemployment figures as they were approaching, or I think had reached for several months consecutively record highs. So I think some acknowledgments in there from Xi Jinping that, yes, the economy is, experiencing some trouble. I think at this point, David, there's a lot of expectation as to what the government actually needs to do in order to bolster economic growth in 2024. Obviously, we know that issues such as the property crisis remain severe overhangs for this economy. Really need to figure out ways to bolster confidence within the economy. I know that there's, in addition to what we just talked about, the potential for maybe rate cuts in the first quarter, there's also, I think, some additional expectation for increased fiscal stimulus heading into 2024. We're still a few months out from the big National People's Congress meeting to kind of determine what things ultimately look like into 2024. But I think that at least seeing that presidential address kind of talking about some of those difficulties maybe indicates that, yes, the trajectory of the economy remains top of mind for the country.
There was also some geopolitical color. It's, 45 years and a day since the U.S. and China established formal diplomatic relations. I think there was a reference to hopefully peaceful coexistence with their key strategic rival here.
Yes, that was Xi Jinping's message to U.S. President Joe Biden. Ultimately, I think, as we gear up into 2024, we've seen some easing of tensions in recent months. I think most notably within December, we saw some reestablishment of some high-level military talks between these two countries. So maybe that bodes well for the relationship. But I'll remind you, David, that 2024 is a U.S. presidential election year, in which case I think, it wouldn't be too surprising to see tensions ratchet up again as you start to see, the Republican Party, certainly frontrunner Donald Trump continue to be, sort of tough on China. We'll see how that translates into what messaging might come out of, Joe Biden. But I think that's one thing that you have to keep in mind in 2024.
Jill, fantastic. Jill Desis there, our China economy editor. Right, just coming up here on shows, the Caixin numbers are coming out, as we were just talking about there with Jill, 9:45 Hong Kong time. That's in about just over 30 minutes from now. Estimates are for 50.3 on your screens right now. We'll break the numbers down. We'll be joined by the chief China economist at BNP Paribas, Jacqueline Wong, as those numbers break. Also counting down to the first session of the year in Shanghai, in Shenzhen, and here in what seems to be a musty Hong Kong. Is it? 60 minutes away, the opening bell, 0.3% to the upside. This is Bloomberg Markets, the China Open. Good morning. Good morning. Welcome back to shows. Stronger on dollar China, or stronger on the Chinese currency. To fix us out, first one of the year, 707.70 is the midpoint estimate, 709.62. Just taking a look at, I guess, the week ahead in terms of economic data. So we're just coming off, of course, the official PMI numbers. In a couple of minutes, we'll be getting the Taishin numbers coming through. Perhaps front and center, as you look at all of these things, we have a lot of inflation prints in the region. And of course, we're looking ahead to the jobs number on Friday. Does that cement, I guess, in many ways? Well, the Fed thinks they're going to do 3 cuts this year based on the dot plot. The market thinks 6. Props were split the difference. Maybe we get 4 or 5. Maybe. Who knows? Joining us here on set to talk about the outlook for equities in the region, Harold van der Lind, Head of Asia Pacific Equity Strategy at HSBC. Happy New Year.
Happy New Year, David.
Your report, 15% upside.
Yeah.
Is the project on price on Asian equities. This is about 5 weeks old, and the last 5 weeks has seen a tremendous rally across equity markets. 15% still holds.
That 15%, the underlying premise of it basically still holds.
Okay.
There's a couple of things we've assumed there. So this report you're referring to, we said in November, maybe bond yields could start coming off in 2024, and that would be good for Asian equities. Over the last month, basically, we've seen a tremendous decline in bond yields, right? We've gone from 5 to what is now 3.8-ish.
Yeah, on a 10th.
On a 10th. So a lot of that actually happened all in December, and that has lifted global equities, US equities in particular, tech markets in particular, but Asian equities have followed as well. So a lot of that is actually happening. What we now need to see is that we see earnings starting to come through in Asia as well. But the underlying premise of that holds. One of the underlying premises, by the way, for China is that market could go either way. There's just there's so many moving things. It's not just earnings and valuations you can look at, but also we have to look at policy risk. We have to look at readjustment in global portfolios and these sort of things that drive kind of sentiment in that market as well, right?
Yeah, and you're still attaching, you alluded to this, a 50% probability. Lay out those two scenarios for us. This is the H-share market, right?
That's absolutely right. So what could happen, of course, is that we get a continuation of last year, that news flow is bad, sentiment is poor, people want to reduce their exposure to China for whatever reason, and we slowly drift lower to the kind of late 2022 levels that we were. October, I think we had a low there. That might happen, right? That's one scenario.
That was the depth of COVID zero, though. I mean, why is it even part of the conversation?
I mean, let's just take that as a bottom kind of scenario, right? On the other hand, if things actually turn okay again, we have more than 40% upside in Chinese equities. If they go back to some average valuation and the growth is holding up as consensus is forecasting, which is something in the mid-teens at the moment, 15% earnings growth or so, and for 2023, it looks like that's going to be a reasonable estimate. So 2024 maybe as well. If you then say, okay, get that growth and you get kind of PEs going back to average, you have more than 40% upside. So let's call that the blue sky scenario, the positive scenario. So you just say, well, both of them might not completely happen, but just put 50-50 to them. You get something in the middle, right? Now, if you do that, you still get 20% upside. What it actually tells you is that the downside risk in China is somewhat limited, and the upside risk could potentially be quite substantial.
Well, how much more underweight can foreign investors get on this market?
So, now we know that certain pension funds, they publicly stated, we want to cut our exposure to China. And that's not for tactical reasons, that's for structural reasons. We've done some work on this, and we think that a lot of that is already washed through the system. But that's right. How much further underweight can they go? Maybe there's a little bit further selling going. Most funds, those are not pension funds, but say mutual funds, etc., that can opt to be in China but don't have to be in China, they've already cut their underweights quite substantially.
Stay with us, of course. We have some breaking news right now, and we'll be back with Harold van der Lind in just a moment here. So some updates here on the big quake in Japan. You're looking at, of course, the Prime Minister there, Kishida, talking about how large-scale damage has been confirmed from that quake. They have dispatched ministry officials to the site, at least near where that took place, of course, over the weekend. Now, we're also getting, and I'll caveat this by we still don't have a lot of details on this next thing I'm about to tell you guys, is that an earthquake has reported to again have hit Japan 10:17 local time, so that's about 4 minutes ago. We still don't have a lot of details on that specific quake, which hit a couple of minutes back. We'll get you guys, of course, an update just in case once we do have more information on that. But of course, we'll keep on top of this story out of Japan. But Harold, apologies there for the interjection. I'll bring you back in. I mean, key markets apart from China this year, the top of mind, the winners: India, Japan, Korea is obviously underpins your earnings premise.
Yeah, so a couple of key markets. Let's start actually with Korea. Korea is going to be the fastest growing market this year. That's a DRAM story. DRAM prices are moving higher. If you look at the share prices, they've already rallied to a large extent.
Yeah.
What I think is going to be more interesting is maybe that there's going to be an increased focus more on Taiwan throughout this year. I suspect that the semiconductor sector there is going to just do a little bit better than expected, and we're going to see more rollout of what are kind of super edge products. If you sell off high-end chips, there's only a few people that initially buy, but that's going to be more mainstream, and that's going to be the story for some of the companies in Taiwan this year. So I think Taiwan is going to be looking okay. Korea, as mentioned, the story is well known. I think the interesting story is maybe going to be more from ASEAN and from India. Okay. India, everybody knows that the growth story is good, but it actually proved out to be even better last year than expected. Earnings growth 25%. That's just phenomenal. Right? The earnings has grown a quarter. That's really strong earnings growth. And then you probably have something around 15 to 20% again this year, slowing a bit. But so I think India will remain on the forefront of people's minds as well.
Harold, nice to see you. Let's talk again soon.
Talk soon.
Happy New Year. Harold van der Linden there, Head of Asia Pacific Equity Strategy at HSBC. Just to recap, the lines coming through out of Japan. This is out of the Prime Minister. He is speaking live. We'll leave you with live pictures of that. And as you look at that, just to recap some of these lines that he's mentioned here, large-scale damage has been confirmed from the quake and that they have dispatched ministry officials to that quake site. And another earthquake has been reported in Japan. More details to follow. Plenty more ahead. This is Bloomberg.
今後とも連絡を緊密に取りながら
All right, futures are mixed ahead of the first session of the year. So we're looking at, well, at least on the A50 contract in Singapore, we're slightly higher. We're coming off highs, though. As we speak, we're fairly, well, not fairly flat. We are flat on the contract here in Hong Kong. We're watching what's happening with bond yields. And, you know, at 254, let's call it even, flip the page. We're actually nearing the lows that we hit last year. And below that, perhaps as you can extrapolate, we're back to levels when the pandemic first hit back in 2020. So there is a rally taking place in the CGB spaces, which is one of the things that we're tracking ahead of the open today. So flip the boards, please, if we can. On top of the bond rally, we are on a big three-day win streak on price on the A-share market. We have some data coming through, of course, out of the Caixin numbers in about 20 minutes from now. Will that reflect broadly the weakness we saw from the official numbers? We'll find out soon. Plus, of course, the open comes up next. This is Bloomberg. Welcome back. First and foremost, from me, the team, Yvonne, we'd like to wish everyone a Happy New Year. And I guess to everyone who's joining us, I guess many of you are in the gym right now, so don't overdo it. There's a whole year to do it. It's not just the first week of January. Speaking of thin trading today across these markets. So when you look at price, might be exacerbated a little bit, of course. But that being said, we're looking at upside right now across your futures, as we were just pointing out there. We're waiting for data to come through on the Caixin numbers. That's the PMI reading coming out in about 15 minutes from now. Broad weakness when you look at the official numbers coming through. I mean, relative to estimates, a bit of variance there. That said, it's perhaps not very surprising that the economy is still lacking momentum, as the president, of course, Xi Jinping, in his New Year's address, promised and vowed to build on momentum, of course, addressing some of the challenges in the economy, particularly when it comes to employment. We're down a little bit on the CSI 300, 0.2%, Hang Seng Index 0.4% to the upside. MSCI China seeing a little bit more upside, which perhaps goes into the tech story, which is HS Tech. Perhaps this is more an index component, a function of index components and structure here, with tech stocks on the way up 1.1%. That should lead to perhaps more price gains on MSCI China itself. Flip the boards, please, in terms of sector movers as well. And when you look at that, just to remind you, we're also tracking this rally that's taking place in the CGB market. We're down 8 or 9 days on the one-year yield. Do we get a further moving up there as well? On the 10-year, you were actually close, as we were pointing out a few minutes back, to the lowest, the trough that we hit back in 2023. Below that, we're back to 2020 levels in that. A brief look at sectors right now. So just the top line, if you don't see that very clear, that's financials, industrials, staples, and real estate. In case you missed it, data, the top 100 developers in China out with December numbers as well. So we're down about 34.5% year on year on sales. For the full year 2023, 16% contraction in sales. And hopefully, really, this year is different, I guess, for the better. Macau gaming stocks up 1% in the early goings. Right. Let's try and paint the picture of what this market looks like this January. Seasonally, of course, it's a good month to be in equity markets. Let's bring in our MLive strategist, Mary Nicola. She's with us right now out of Singapore. Mary, well, good morning. Happy New Year, of course. Let's look at markets. What are you watching out for today and the next few weeks?
Yeah, I think the main key theme this past week is going to be that the optimism that we saw at the end of 2023 is likely to roll over into 2024. However, there's a challenge that's coming through, especially for China, where China PMIs are still disappointing, showing that the drip feed stimulus that we saw over the course of 2023 hasn't really had such a strong impact on the Chinese economy, which is likely to impact sentiment, especially in equity markets. And of course, you look at valuations within China equities, they're still really attractive, but we still need that revival of animal spirits to really come back to bring Chinese equities back up. And that's going to take a little bit more, and that's going to come from, better economic readings, a stronger improvement there, some sort of resolution in terms of on the property sector. These are some of the things that the market will be looking for to see a full rebound in China equities. But for now, the outlook for China equities overall and even Hong Kong equities as a result looks quite dismal. But if we look at broader Asia, let's say take Korea, let's take Taiwan, and some of the other export markets, we have seen a strong recovery in goods exports. So that's likely to support the likes of Korea, Taiwan, Thailand, and they should see some further recovery as a result of that export recovery. And we've seen the numbers too coming through. So some of the other Asian markets will likely to see a continued, a sustained recovery, benefit from that optimism that we've seen towards the end of 2023, but China still remains the wild card.
Yeah, absolutely. We were just talking with Harold van der Linden of HSBC, and frankly, their report looking at this year had a 50% probability that the market falls substantially or rises substantially, which I guess, to your point, underscores the wild card notion there. Let's look at the dollar. The MLive team, of course, has been forecasting weakness in the dollar. Is that a function of rate differentials? If not, what is it a function of? Or just underscore that point there, Mary, if you could.
Sure. There's a few key factors that we looked at in terms of underlying what is the dollar trajectory for 2024. The first thing that we looked at was just if you look at real rates, so take the central bank rates adjusted for inflation, we find that the U.S. is actually the most restrictive. So they've hiked enough, and now we're seeing a decline in inflation. So PCE numbers for November on a 6-month annualized basis was was close to target, showing in fact that if we get two more numbers in that same vein, that there is very little excuse for the Fed to start cutting as soon as March. So vindicating already what the markets are believing. And of course, because policy is so restrictive in the U.S., there is more room for the Fed to cut versus, let's say, the ECB and let's say versus the Bank of England as well. So and then on top of that, the Fed wants to engineer either a soft landing scenario or a no landing scenario. In order to do that, we need to have real rates a lot less restrictive for the economy to ensure that we get that soft landing, no landing type scenario into 2024.
Mary, just to follow up on that, the Fed's last dot plot, I believe, penciled in three rate cuts this year. The market's expecting double that. Do you think we're closer to 3 or closer to what the market thinks?
I think, especially if we're seeing where the disinflationary pressures are coming through, we're likely to be closer to 6. There is no reason for the Fed to stay as restrictive as possible when inflation is really coming off, and then when we're also seeing some softer signs of the U.S. economy. The U.S. economy, no question, has been very resilient. Even some of the signs of softness still shows a fairly robust economy, but just a little bit softer than what it was before. But on the other hand, the main factor here and going forward is the fact that if inflation is declining, do we really need real rates to be that restrictive, especially if you're trying to engineer a soft landing or even a no landing type scenario for the U.S.?
Mary, fantastic stuff, as always. Mary and Nicola there in Singapore for us. One mover to tell you about, stock mover that's in China. Of course, 6 minutes into the session is Baidu. So we opened about 3% higher. We're now 1.2%. So coming off highs right now. So two related lines here to tell you about. So this deal to purchase YY effectively expired when the new year lapsed. That's a 3-year deal. We didn't get, of course, regulatory approval for that. But according to the city, that's actually a positive outcome there. And as you would imagine, it's 3 years in the making. That did not happen. So well priced, 1.3%, the stock price right now. And Citi saying, as we were pointing out, that is good. Maintaining its buying recommendation. Target price, 178 for the ADRs, of course, which closed on Friday, 119. So just split the difference there as far as the Hong Kong listing is concerned. Right. Let's move to a Bloomberg scoop and staying relatively in tech here, of course, on the U.S.-China tussle over semiconductor supremacy. We've learned that ASML has actually canceled some shipments of its machines to China at the request of the White House. Let's bring in more details. Let's get more details on this story and the scoop from Bloomberg here with our Asia tech reporter, Jane Lan-Hee Lee. Yeah, Jane, what can you tell us? Tell us more about this.
Right. I mean, the ASML machines are lithography machines. So for very advanced chips, these are the machines that help carve into you flash sort of light in order to make a pattern and carve the tiny little transistors out. It's a key technology, and the Biden administration has wanted to stop the export from the Netherlands to China of these machines. In June, the Dutch government went along with the U.S. and said, okay, these certain top machines will be banned from 2024, and knowing that, the Chinese have just rushed to stockpile. China has been working really hard to have self-sufficiency in chip manufacturing. And the Biden administration has been quite upset with the fact that SMIC, China's top chip maker, was able to manufacture a 7-nanometer chip for Huawei's smartphone that was launched in September. And so it put pressure, according to our sources, on ASML to stop shipping these machines so early before that deadline. And ASML has since put out a statement saying that indeed they have stopped shipment of some of these top machines to a small number of Chinese chip makers, but said that the impact on its 2023 outlook would be limited.
Yeah, I was going to ask you, do we know how many machines they actually did not ship? And it's worth noting as well, correct me if I'm wrong, they were asked not to ship them before the restrictions actually took effect, correct?
That's right. So the ban came in, the Dutch government announced the ban in June, but the deadline for that ban was 2024, so yesterday. And the Chinese just ordered crazy. If you look at some of the numbers, for example, in the third quarter for ASML, about 50% of its sales came from China. That's up from like 24% of sales to China in the second quarter. So it's very, very clear that China was buying. Everyone was doing this. It was out in the open. According to Chinese import data between July and November, import for lithography machines, not just ASML, but overall, it was 5 times the level it was the same period last year. So the stockpiling was really out in the open, and it's clear the U.S. government was not happy with that.
Jane, thank you. Jane Lanhee Lee there, our Asia Tech reporter on our Bloomberg Scoop. More on that, of course, if you guys want to read about that, that's all on the website and also on the terminal. Now, more on geopolitics that we're tracking and the stories we're tracking right now. Chinese President Xi Jinping has used a New Year address to reiterate that China will surely be reunified. That's a reference to Taiwan, which Beijing considers a rogue province and has vowed to claim by force if necessary.
The reunification of China is a historical inevitability, and compatriots on both sides of the Taiwan Strait should join hands and share the great glory of national rejuvenation. Our goal is grand and simple.
Meanwhile, Taiwan's President Tsai Ing-wen used her New Year's speech to call for Beijing to help maintain peace in the region. Her appeal, of course, comes 2 weeks before an election dominated by debate over the island's ties with China. Now, Iran has sent a warship to the Red Sea after the U.S. Navy sank 3 Houthi boats in a confrontation that took place on Sunday, and that's on the weekend, of course. Now, the move could be seen as a challenge to the U.S.-led maritime task force established to halt attacks by the Tehran-backed rebels. Now, the U.S. Navy says it was fired on as the Houthis attacked a Danish-owned container ship. Container line Maersk said on Sunday that it was halting transits through the Red Sea for 48 hours to assess the security situation. Now, Israel is pulling thousands of troops out of Gaza, shifting the nature of its war to more targeted operations, and it follows U.S. pressure to reduce civilian casualties and their need to return reserve soldiers after nearly 3 months of combat. The withdrawals will begin this week. Now, top Israeli officers, though, say that the war against Hamas will continue for many more months. Right. In a couple of minutes, we'll be getting the Taishin December PMI numbers coming through. A live look at a beautiful winter morning in Shanghai. 2 minutes away, this is Bloomberg. Right, welcome back. 15 minutes, nearly 15 minutes into the cash market session. We're down 0.7% after a 3-day rally. In a couple of seconds, we'll be getting the Taishin China PMI numbers coming through. So, well, the number you're looking for is 50.3, 50.8, so better than estimates, at least median estimates. Of course, this is a different sample size. It's more export-oriented, smaller-sized companies compared to the official numbers, which came in at 59 was the headline number, which missed virtually every single forecast on the official numbers, by the way, with the exception, I believe, of one. Okay, let's get a sense of what this means for December and what this means for the economy as we, I guess, turn the page on the calendar. Let's bring in Jacqueline Rong, Chief China Economist at BNP Paribas, joining us from Beijing. Good morning and Happy New Year to you, Jacqueline. Just your initial take on the official numbers, and if you heard me, perhaps I spoke too quickly, 50.8 on the Taishin numbers.
Yeah.
Your initial take.
Oh, I think it's not surprising that we've seen discrepancy again in the official PMI survey and the Taishin survey. I think this is the second month that the official PMI looks disappointing, while Caixin PMI surprised to the upside. But we tend to believe that the official PMI surveys, they actually reflect the momentum of the economy more accurately because of the different scope of their respondents and so the different methodology they use to compile the data. So we tend to believe actually economic momentum, both in manufacturing and the service sector, has sort of like moderated towards the end of 2023.
Okay, so this is the first set of numbers for December. What do you think the activity numbers will show for December, Jacqueline, to your point?
Okay, so the National Bureau of Statistics always report the year-over-year growth figures for retail sales, investment, exports, and industrial production. I think those year-over-year figures will show another rebound because of a base effect. However, if you take a look at sequential momentum, like the PMI surveys is about month-over-month change, we think that the momentum on a sequential basis has actually moderated.
Okay, talk to us about, and we've been talking every time we have you on the shows. We talk about the property sector and consumer sentiment. How would you describe consumer sentiment right now, Jacqueline, on the ground?
I would say consumer sentiment remains downbeat, and the National Bureau of Statistics, they have good consumer confidence survey every month. And in the past couple of months, we continue to see the general consumer confidence and also expectation about income and job market continue to hover at sort of like historical low levels. And in terms of property sales, I think towards late December, Beijing and Shanghai relaxed property policy again, but it did not really lead to a significant rebound in property transactions. So we think probably more policy easing is needed to fully revive the property sector.
Yeah, and they've increased the fiscal budget. I'm going to get to a two-part question was, when do you think we'll start to see materially in the numbers the increased spending in the fourth quarter of last year? And what do you think is appropriate fiscal deficit for this year when they come up with that target in March?
Oh, well, we think probably the size of the overall fiscal impulse to the economy would be roughly the same as last year. For instance, probably around 3% budget deficit as a percentage of GDP, and probably another 1 trillion, say, either special or general CGB issuance. And probably in terms of special LGB, the size would be roughly the same as last year, around 4 trillion. So in total, I would say the total size of fiscal impulse would probably be by and large the same as last year. But for Q1,
right. Go ahead. Finish your thought. Sorry.
So for Q1 this year, we will probably see an acceleration in fiscal spending because the 1 trillion CGB approved in late last year, most of the process has not really been put into use yet, and that will be reflected in fiscal spending in Q1 this year.
Okay, so net, so Q1 this year, and you mentioned we'll roughly be working with a similar fiscal deficit target. My simple question is, where will the economic support come from? Is that going to be enough to push this economy out of the current mindset that consumers are in right now?
I think they probably need to do more, but they take steps to do things. The Central Economic Work Conference has already mapped out a modest size of stimulus, some support for consumption, probably a little bit more monetary easing, and also a little bit more fiscal stimulus as well. They will wait and see and assess the impact. It is not sufficient. I think sometimes they may have to do a little bit more.
Okay, it's the start of the year, so might as well, Jacqueline. What are your forecasts for 2024? Growth, inflation, and maybe one more metric you think is important.
Okay, so for GDP growth, we forecast it will slow to 4.5%, and 4.5% is actually not an easy target, but because this year we no longer have the support from low base effect, so the government need to work a little bit hard to retain 4.5% growth this year. For inflation, we think CPI probably around 1.5%. For PPI, it will continue to be negative this year, but the degree of deflation in the industrial sector will be somewhat better than last year. And in terms of other metrics, I think that is important to watch in China. It's definitely all the indicators about the property market, especially property sales and property investment.
Okay, well, we'll see if that improves. That seems to be property, that is, seems to be what underpins everything else. Jacqueline, have a great 2024 ahead. Jacqueline Rong out of BNP Paribas, out of Beijing for us. Plenty more ahead. This is Bloomberg. Good morning. How do investors and markets feel about this Chinese equity market? On one metric, I think it's a Hang Seng, trading at 8 times earnings. That's less than half what Japan is trading at, about half what India is trading at on a price-to-earnings basis. So we asked our clients, do you plan to increase your exposure to China over these next 12 months, so effectively 2024? It's almost an even split between all these four here, but incrementally, slightly more will be tending to increase their exposure. That being said, of course, we're coming off an extremely low base, so chances are, if there is any change, that's an increase in exposure. The biggest problem right now, what is holding you back? What is holding the economy back? And this one is fairly more, you have a bit more consensus here. It's property. 50% think that's the main issue there. We'll see whether that resolves itself with the support of the government throughout the course of the session here. A couple numbers to tell you about in the session, the year. BYD, we talked about Baidu. Citi says that's a good thing that deal expired. And we'll leave you with a look at Chinese benchmarks and some sector movers in the bond rally that's taking place 25 minutes into the session. And in case you missed it, the Taishin numbers came in higher than estimates. Plenty more ahead. This is Bloomberg.